As the fourth quarter begins to kick off, earnings coming, and is the market ready for a reflex rally? That's coming up on 3 Minutes on Markets and Money. Well, after a brutal drubbing in the month of September, stocks sold off, setting new lows for the year. Is it time for a rally? That's the big question here. Markets are extremely deviated from long-term means, of course. We've talked about this before. And historically speaking, these tend to be opportunities for at least reflexive rallies in the markets. Again, an opportunity to reduce risk. Even in bear markets, you tend to have decent rallies to sell into. Look, there's a lot of problems coming right now. The Fed is very close to probably breaking something in the markets or in the economy itself. So there is certainly concerns here about further downside risk that are certainly warranted. Right now, markets are extremely oversold from their 200-day moving averages. In fact, one of the bigger deviations for this year already. The last time that we had this big of a deviation, the market rallied all the way back to the 200-day moving average, really kind of retesting that downtrend line. Again, now markets are very deviated once again below that level, which suggests that probably markets will rally back towards that 38 to 3,900 level on the S&P 500, retesting that downtrend 200-day moving average. Again, if we go back in history, we can see that previous big deviations from the 200-day moving average have typically been associated with at least short-term market bottoms or potentially a rally back to those 200-day moving averages before setting up lows. In fact, in 2008, exactly at the point where we are right now, the market was selling off, rallied back to the 200-day moving average before the Lehman event caused that very sharp drop in the markets. But again, big deviations below the 200-day moving average have repeatedly been good opportunities for a reflexive rally. So how do you trade that right now? Well, you can certainly, if you're a short-term trader, add some exposure to your portfolio. Pick up an S&P 500 index as an example, just to trade this market higher near term, pick up a little bit of gain for the year. But as you begin to approach that 200-day moving average, that's going to be a level that you want to reduce that risk, rebalance your equity risk in your portfolio. If you're a longer term investor, good opportunity to raise some cash, reduce your risk, because again, at least for now, the risk of something breaking in the markets, a more credit related type event, is still very prevalent. So again, you could wake up in the morning one day and have the markets down, 1,000 points, whatever it is, and you certainly want to try to avoid that. If the market begins to trade above the 200-day moving average with some confirmation, that'll be a better opportunity, or at least a better signal, to add exposure back to the markets. Yes, you won't buy the actual bottom in the market. That's okay. That's not the goal here. The goal here is to try to maximize our upside, minimize our downside risk. So again, for right now, use rallies to reduce exposure, rebalance risk, raise some cash. And as we get through this, we'll know better about what to do next. I'm your host, Lance Roberts, for 3 Minutes on Markets and Money. See you back here tomorrow. SEC charges Kim Kardashian for unlawfully touting crypto security. Ha! Serves you right.